a sideline hobby was looking into a lease-to-own mortgage system. We started looking into it more seriously as the subprime mortgage crisis was ballooning, and we thought maybe there might be some possibilities there for dealing with that. But we discovered something that we realize now would actually help solve this real estate crisis actually very easily and very quickly and very affordably. There's many different ways to approach a lease-to-own, but we found that the auto lease-to-own specifically will pay off a loan up to 40% faster than your real estate loan. It actually seems miraculous, but again, it's just almost amusingly simple. Just to give you a quick summary so you have an idea of where we're going with this, there's 3 primary steps. The first is you take a loan, you divide it into 2, the first one being paid off over 4 years. The second step is that you then add a down payment to this first loan, which dramatically reduces the monthly payments, as you will see. The third step is that the second loan is held during this 4-year period by the bank or the developer or even the homeowner, and they write off the interest each year. So the simple interest comes out to about 20% of the loan, but the compound interest comes out to 40% of the loan, and you'll see what I'm talking about once I show you the numbers. So let's take the example of a $200,000 loan, which is what the average is of the subprime mortgage. On a 30-year, $200,000 of the loan. Here we're using 6.6% because this is a decent interest rate for banks. This gives us other options, as we'll show later on. Paid over 30 years. That's an average of about $1,300 a month. Now look what happens when you apply our system to it. We're going to dramatically reduce that. So let's go over here to our system. And here we've divided up the loan into 2 parts. So here's the original $200,000 loan. Still the 6.6% interest, but it doesn't have a decimal in this. We've taken 25% of that $200,000 loan, which is $50,000. And again, that 6.6%, it's just as affordable at 7%, paid off over 4 years, and that comes out to $1,219, which is about $70 less. Simply dividing up the loan in this way, it's about $70 less. Now, here's the miraculous part, if you will. So here we're taking a $20,000. This is for the first down payment of the first loan, and add that in. There it is. Our monthly payment has gone from $1,300 a month on a 30-year loan down to $731. What we've done here is we've cut the mortgage by 50%. I mean, that's huge. So what this means, let me look at my notes here, is that it cuts it because of when you include the compound interest. So even though $20,000 is only 10% of a $200,000 loan, when you apply that to a $50,000 loan, this $20,000 represents 40% of that. So even though it's only 10%, it impacts the loan by up to 50% when you include the impact of compound interest. And we think that it's essential that we reduce mortgage payments by this dramatic degree. And there's several reasons why. The number one reason is that there's a number of markets where the property values have fallen as much as 50%. So at these rates, we can sell our properties even in those markets. Now, today's market price is actually sort of the baseline for finding out what a market value for a property is what the rent is. And so when the mortgage payments can equal what the rent values are, in other words, that's what the local market can afford, then you know that it's in parity. So right now, mortgages are triple in a number of markets of what people can get for rents. So if we can reduce them where the rent is equal to the mortgage, that's the market value. In our system, we actually reduce the mortgage payments to, in a number of cases, be even less than what it would take to rent. So it's cheaper than rent. Here's another really important reason. Right now, all the programs that they're talking about providing to help this situation is the bare minimum. In other words, instead of people paying $1,300, they'll only pay $1,000. So that 30%, and they're raving that this will help. Of course, it will only help about 5 or 10% of the troubled mortgages out there. There's about 3 million to 4 million potentially potential foreclosed properties that will go into foreclosure. And what they're saying, they might be able to help 300,000 or 400,000 of those. We can help 100% of them. And if we do that, what we will have done is 3 things. Number one, people now have less debt. So their credit rating is all dramatically boosted. The second thing that it does is that all the industries that have been being squeezed because people no longer had money, they too will now start doing better because people can once again afford their auto loan, their student loan, their credit cards, their food and their gas prices. So people will now have significantly more petty cash to work with. They'll have less debt. All these other industries, from banks to schools to the auto industry, they'll also begin to do better. And what this means is that the U.S. economy now has less debt and has more business. In addition to this, and this is the reason why we talked about the interest rates, remember, we're getting up to about 7%. So right now, the Federal Reserve is charging only 2% on their, here's the 7% interest rate, or 6.6% interest. So at these kinds of interest rates, the Federal Reserve, they too can also raise their interest rates. So instead of it being 2% or 3% or 4%, they can go as high as 4, even 4.5%. So here you have the U.S. economy with less debt, more spending money, and paying out a higher interest rate on the U.S. dollar. This means that the value of the U.S. dollar will dramatically jump. So if you look at the price spike of gas, what's happened with that is that we've gone from about $2 to $4 in hardly a year's time. And out of that $2 price jump, 50% of that was the value of the U.S. dollar going down. So if we can reestablish the value of the U.S. dollar, that means that we can cut 50% of that price hike of gas. So instead of it being $2 more, it will only be $1 more. So instead of a gallon of gas costing us $4.25 a gallon, we can bring it down to $3.25 a gallon. Here's a little interesting thing, and it came up from the whole debate that we had a month or so ago with John McCain and Hillary Clinton and Obama, where they're saying, well, let's cut taxes, and everyone's saying, well, it's an incidental amount. It doesn't really equal much. It doesn't come to much. And in fact, the federal taxes only does come to 20 cents, 19 cents actually. But what I came to find out from some great articles is that the average state tax is between another 40 and even 45% per gallon. So when you put these two together, you're now looking at an additional 60, 65 cents. So if we were to get this summer holiday, as they talked about in the campaign, from both of these taxes for just 6 weeks or 2 months, we'll have dropped the price from, we'll save $1 from the increased value of the U.S. currency, and then we can cut off another 60 cents by this tax holiday for 6 weeks to 2 months. The price of gas we can get it for as low as $2.50 for the next 2 months. So again, this will dramatically improve the economic performance, but this will only happen if we can radically reduce the monthly mortgage payments people have. So what we actually have here is the equivalent of a stimulus package, but at the same time it's a deflationary stimulus package rather than an inflationary one. So we have this historic deflationary stimulus package. It's actually quite phenomenal. So this will all be possible if we can bring down the mortgages by this 50%, and therefore we recommend that this system be applied to all home mortgages, if possible. Now, The question then becomes, where does this $20,000 come from?